Stock's off to a pretty good start this year. The question is, where are the best opportunities right now in that space? Let's ask Scott Black. He is president and founder of Delphi Management. It's nice to see you. Welcome back.
Thank you for inviting me.
We'll get to stocks in a moment, but generally speaking, how are you feeling about value when the week itself here was so dominated by questions about growth stocks?
To be frank with you, if you look from the statistics from 2007 on, value has systematically led growth, and large cap has dominated mid cap and small cap by a wide margin. But what we do is we're bottom-up stock pickers. We're indifferent whether it's large cap, small, or medium. We're just looking for high return on equity companies that generate cash that can be bought at low valuations. So that really hasn't changed over the years for us. So it's not about picking the homogeneous risk class that's going to do well.
I think that's why our viewers like hearing from you. You cut through all the noise and just get to bottoms-up stock picking. Let's talk some names if we could. You have some stock picks for our viewers. SNX, TD SYNNEX. Tell me about it.
Yeah, it's probably the quietest $61.6 billion revenue company that nobody ever heard of. It's an IT distributor. It's based in California. And essentially, they distribute computers, peripherals, etc. They also have a manufacturing process called Hyve, H-Y-V-E. I've been to it. I actually visited it, where they configure basically CPUs and GPUs for companies like Meta, for example. And that's a better business. So the company should do approximately $12.85 for the coming year. That's based on our own model. The stock is around 141, which places it at an 11 multiple. If you want to take out the 80 cents in stock-based comp, it's in about 11.8 multiple. The company will do about 13% return on equity and about 10% return on total capital. And over the last few years, they generate more than dollar for dollar in terms of free cash relative to net income. The last couple of years, they generated over $1 billion in free cash, and they bought back $1.2 billion worth of stock. They have a deleveraged balance sheet to begin with at 0.35, and it's a triple B minus, so it's an investment-grade company. So there are two divisions to the company. The first division are mundane businesses like selling PCs and iPhones, and that constitutes about 43%. The more upscale thing is configuring. It's doing stuff like networking and cyber. The Hyve business, which is making upscale computers, GPUs, that's about 57%. That business has much better margins. That does gross margins over 8%, whereas the regular distributions are 4.4%. So overall margins are lifting as they go more into the advanced business. And now somebody's going to ask, because we just see retaliatory tariffs coming, are they big in China? The answer is no. They only have about 6% of their business in Asia. Most of it's Japan. They have almost no business in China, so you don't have to worry about doing business there.
Okay.
The bulk of the company is in North America, 60% of the sales, and Europe's about 33%. So I guess, you know, you're buying something at 11 multiple. Top line revenue growth is 5 or 6% this year. Bottom line is about 10%. It's pretty good value considering the S&P multiples is 23 times. You're getting it at half the multiple of the S&P 500.
All right, let's do one more. Ultra Clean Holdings. The ticker there is UCTT.
Yes. We already own Applied Materials, KLA, and Lam, but those were all 19 to 23 times. This is a surrogate play. They're big with both AMAT and Lam. Lam is their biggest customer, 31%, Applied Materials, 21%. What they do is they make subcomponents for AMAT and Lam. These are critical things like gas chromatography, chemicals, that type of thing. There's not much competition for them except the parent companies themselves occasionally do it, but they're outsourcing it. There's a little company called Ichor, which is about 40% the size of Ultra Clean. On a multiple basis, it's a $36 stock. We think they're going to earn $2.85 at the low end. That's my own conservative estimate, having spoken to the management. It's about a 12.7 multiple. The return on equity on this one is 14%. The net debt equity is about 0.19, so the return on total capital is 12%. This is a smaller company, only has, a 1.6 billion market cap, but they're still generating about 125 million in free cash. It's a well-run company. I've had the management visit me in the past, and I think it's a decent value. It's selling at roughly 7 multiple points lower than AMAT, KLA, and Lam.